Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, global markets rattled by recession risk, driving junk bonds lower and yields higher as Chair Powell hopes to tame inflation. We begin with the big issue, wrapping up another messy week.
Global bonds are selling off.
Bond market rallying.
6 months of fixed income markets in real turmoil.
We're hiking rates into a stagflationary environment.
Financial conditions are tightening and the risk of recession is rising.
All the recession talk, credit risk has woken up.
Yes, there's worries out there about credit risk, but I do think a lot of corporates have the fundamental support of their balance sheets to be able to weather that.
We see opportunities in credit now as well. Credit has repriced.
The bond market is not pricing in a recession.
Everybody likes to talk about the Fed put and how far equities or credit have to fall before the Fed panics.
We're probably in for a bumpy ride, a roller coaster rate profile.
Joining us now to discuss is Megan Grafer of Barclays, Schwab's Colin Martin and Jim Bianco of Bianco Research. Megan, first to you. Let's just reflect on a week gone by. Lessons from this week, what are they?
Yeah, I think we are seeing, risks amplified as we round out the week. It's been an incredibly bearish backdrop emerging, and I think conviction low, liquidity thin, and market reactions, or, at least the velocity of those market reactions, I think proving to be far less predictable.
Jim Bianco, I know you've got a ton of things to say about the Fed. Let's start right now.
Yeah, the Fed has gotten this completely wrong. And because they've gotten this completely wrong, we're seeing the consequences of it this week. It is very apparent, even from what Chairman Powell said today, they're committed to 2% inflation. Another way of saying that is they're committed to a recession, because that's the only way that they're going to get it. And that's why you see stocks down 6% this week. You've seen the extraordinary rise in yields this week. They've got no other tool, John. They have to just pound the economy to try and get inflation down. And it's being taken out in financial markets.
Jim, something that speaks to that was just the line that I saw from TIAA. Just stuck with me. Here's the quote. Are they chasing something they're not going to be able to catch? Do you think they are?
To some extent, I think that they are, because there's been a fundamental change in the economy since the pandemic. This is not 2019, and it's never going to be 2019. And the sooner that the Fed and everybody else understands this is a different economy from 3 years ago, that doesn't mean bad, it means different, then the sooner we could get about fixing supply chains, fixing the excess demand problems, and fixing inflation. But we're not ready to have that conversation, so they're trying to fix something they fundamentally can't.
And Colin, some strong words there from Jim Bianco, that this Fed, with its current monetary policy stance, with the objectives it's laid out, is committing to a recession. Do you share that view?
We'll stop short of that, but we think the end result is likely to be slower growth. But who knows about the R word? But it's hard to argue the impact of what this aggressive pace of rate hikes will do. We're a little bit less optimistic than what the Fed projections are pointing to. There should be some real consequences to this aggressive pace of rate hikes, regardless of if the Fed, can solve these problems or not. They've told us they need to be aggressive. They told us that, and we're going to take them at their word. We have not seen clear and convincing evidence that inflation is coming down. If anything, it's really the opposite right now. So they've kind of cornered themselves a little bit where they need to continue hiking aggressively. And unfortunately, we think the results are going to be additional tightening of financial conditions and slower economic growth.
Colin, your colleague and our good friend Kathy Jones turned around and called these forecasts aspirational. We've heard them called fantasyland, fanciful by the likes of Diane Swunk and Scott Minerd. Mohammed Al-Erin was on with us this morning and basically said the same thing. What is it about these forecasts, Colin, that you look at in the summary of economic projections and say, I don't think you're going to get there, I think this is going to be worse?
Certainly one thing we look at is the labor market. It was a step in the right direction that we saw an uptick in the projections for the unemployment rate, but it's just so minor. And we are seeing concerns with the labor market ourselves. Yes, there are areas of strength. If you look at the unemployment rate at under 4%, it's been there for a little while now. That's a good thing. But what concerns us is just the anecdotal evidence we're seeing of layoffs out there. I mean, you can't deny that. It seems like almost every day there's there's a headline about layoffs, hiring freezes, something like that. And what also concerns us is jolts. I feel like a lot of people fall back on that high number of job openings out there as if it's almost a buffer, right? If things do slow down, maybe that those job openings just get wiped away and we maintain the level of employment. I think that is, to steal Kathy's point, aspirational, and those will probably get wiped away, and we'll probably see some loss of jobs. So we think there'll probably be more of an uptake in that unemployment rate.
Their current projection 3.7% for year-end 22. For 23, they've got 3.9. For 24, they've got 4.1. Colin, Jim, you're not alone. Bank of America are with you. This is the quote from them. Our worst fears around the Fed have been confirmed. They go on to say they fell well behind the curve. They're now playing a dangerous game of catch-up. We look for GDP growth to slow to almost zero, inflation to settle at around 3%, and the Fed to hike rates above 4%. Megan, I'd love your view on this. You and the team over at Barclays, where are you on this? Inflation to settle at 3%, Fed rate hikes above 4%, growth to zero. Do you share that pessimism?
Yeah, I think the Fed is ultimately trying to buy themselves some room here to evaluate the impact of this more hawkish pivot. I think there's some frustration in the market as they talk to investors that, as hawkish as their statements have been, that Powell seems to have developed this proclivity to sort of backpedal and sort of temper that more hawkish messaging as he gets into the Q&A sessions. But what we know and continue to see is that, strong monthly momentum inflation pressures are unlikely to subside. Excuse me. I think we've got to assume that's going to carry through the summer months. The Fed's going to prioritize price stability over a soft landing, even if that means there's meaningful collateral damage to both the consumer and the economy. But, I'm not personally convinced that it's, realistic for the Fed to bring down inflation to that 2% target, barring some relief from some of the more exogenous price pressures in tandem.
Megan, what we've seen is volatility. What's been amazing for me just sitting in this seat is just putting out the research of various banks and having the pushback, just listening to the pushback. First, it was Bank of America. Ethan Harris said a hike at every single meeting this year, and I got pushback against that. Then Andrew Hollenhorst came out over at Citi and said 50 basis points the next 4 meetings, ton of pushback against that. Jim Bullard raised the prospect to 75 basis points, and I've said this repeatedly all week. I laughed at the time, and here we are at 75. It's the volatility and how quickly some of this has changed, Megan, that gets my attention. And in the news conference, the chairman's now talking about Mitch. University of Michigan comes out every single fortnight, every 2 weeks. So are we going to get volatility around Fed projections every 2 weeks based on what inflation expectations look like in the University of Michigan Consumer Sentiment Survey? Is that what's in store for us this summer?
I think that's right. I mean, I think we're seeing that in market reactions. On the heels of the 75 basis point move, we saw a relief rally, which I think was not wholly unexpected given some of the risk reduction that played out into that meeting. But it just as quickly unraveled, I think, as the market tried to think about the trade-offs between inflation and negative growth. And I think the market is still trying to wrap its arms around the low likelihood that inflation peaks before August, that data dependency that you're referencing is going to define the U.S. We have 3 inflation prints and 2 UMich releases ahead of the meeting on the 27th. So they're volatility-inducing moves, undoubtedly. And I think we've got a Fed whose credibility, following more than one misstep, is being called into question.
Citigroup's on board with this. Jim, I'd love your reaction to it. They said volatility may prevail at least for the next few months, as markets will now reprice Fed policy based on each monthly inflation reading. Now, Jim, if you can remove some uncertainty, I know it sounds cliche, but I think the market can regain a firmer footing and some confidence. The problem I have right now is I don't think anyone really knows what the glide path is going to look like for the Federal Reserve based on how much volatility there has been over the last few months around that story. How much longer do we need to restore some confidence, at least gain a little bit of visibility about what the future Fed path looks like?
Oh, I think it's going to take several months. As you pointed out earlier, we have no evidence that there's been any peak in inflation at this point. The Cleveland Fed Nowcast, which is a widely watched measure of what June is going to be, has got another 1% reading for June and a new year-over-year high at 8.7, 8.8%. Now, they could be wrong on it, but their record is reasonable in trying to predict that. And if we get that, then that locks us into 75 basis points at the July meeting. And it would take 2 or 3 months of slowing data for them to back off of that kind of a move.
Hey, Jim,
and I might add to
we've got
John,
another problem. Can we throw in the growth side of this as well? Because you mentioned the Cleveland nowcast on the inflation side. Look at the Atlanta Fed GDP forecast nowcast on GDP. Where's that? That's a 0. So what's that going to look like for them? The question I asked earlier this week, repeatedly in fact, today, is whether the dual mandate, both sides of it, are now already in conflict right now.
Yeah, no, I think they are. And I'll quote Mohamed El-Erian from this morning. You know, the Fed could either fight inflation or they could pivot and they could deal with a slowing economy. And they're going to pick a third option, which is the worst one. They're going to flip-flop between the two back and forth and have no consistency in where they're going to go. And as Megan pointed out, we kind of get that with the statement. You know, they come out very hawkish on the statement, and then he backpedals in the meeting. So there's a question about the consistency and what the Fed wants to do. They say one thing, but when they're pressed, they back off of it. Are they really committed to fighting inflation and become Volcker 2.0, or are they really not? And that's what we're going to find out, I guess, this summer.
Colin, final word on this. Do you believe the two sides of the mandate, the dual mandate of the Federal Reserve, are already in conflict, or is that what's in store later this summer?
I think later this summer they will be, and I'll agree with both Jim and Megan, where what the markets need is some sort of clarity, and we don't have that right now. If anything, we're more uncertain now than we were just a week ago. And what we'd like to know is what are the plans? And unfortunately, this is going to take a little while. It'll take a few more inflation readings. It'll take a few more University of Michigan readings. As you alluded to, this is something that, you know, we paid attention to, but wasn't something we were going to watch every single Friday. Now we're going to be glued to it. So it's going to take some time, and it's going to take, you know, hopefully some clarity that inflation is starting to roll over. Until that, we're not going to get that, and I would just expect more volatility going forward.
Colin, Megan, Jim, stick with us. We're going to be talking about credit in just a moment. Up next, the auction blog. U.S. investment-grade debt sales going dark. That conversation up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe with a host of rate decisions limiting issuance to just 3 billion euros, the lowest volume since August 2021. Volatility keeping a lid on issuance in the US, the high-grade bond market heading for its first week of zero sales since 2020. And high-yield debt issuance going quiet as well. Just one loan deal coming to market, raising a modest 1.3 billion this week. Sticking with credit, we caught up with Morgan Stanley's Vishy Tripator, recommending investors stick with high-quality names. Take a listen.
This could be a recession where we will see a pickup in corporate defaults, but not a spike in corporate defaults, because we are entering this at a very different point on the corporate balance sheets, as well as the household balance sheets. We would be looking to own more investment grade over high yield and leverage loans, and within the high yield complex, we'll be looking more towards away from loans, more towards higher quality high yield bonds.
Back with us, Megan Graper, Colin Martin, Jim Bianco. Megan, I was going through your notes and something just leaped off the page. This quote, a lot of good news. Can you talk to me about the good news out there that I don't think resonates with everyone?
So there are good news on two sides of the spectrum, one on the demand side and one just thinking about investment grade underlying technicals. I think if we start with the latter, you know, we're on the longest streak of no supply since the summer of 2015, which while some people might perceive that as a negative, it does create a bit of opaque, visibility in terms of where fair value resides. Being down 10% on supply is more a function of borrowers who have the luxury to wait for stability and who have maturity towers that are incredibly manageable as we move into these more volatile backdrops. So if you look at IG, 85% of IG maturities fall beyond 2024. And in the high yield market, it's a similar dynamic. I think only about 6% or so of maturities are coming due in 2022 for the balance of the year and in 2023. So there's an ability, not a lot of urgency to move into these periods where things feel a bit more distressed. And it's happening at a time where dealer balance sheets are at a third of what their one-year max is. So there's a lot of dry powder, strong cash positions that I think are going to prevent a demand collapse in the midst of an undersupplied backdrop. There are investors, as we've talked to in the last 48 hours, who are prepared to buy on any sustained stability. And I think we saw some signs of that yesterday. Dealers were lifted on close to $2.5 billion of investment grade debt, and it was across the curve. So there was buying and renewed appetite for long dated liquidity as well, with the IG index back to 5% and with an 8.5% coupon now on the high yield index as well.
Megan, I don't expect you to talk about specific clients, but I'd love a bit more colour there. Are those clients different to the ones that have been doing that all year? Is this new money, cash that's been on the sidelines, starting to come in because high yield spreads have blown out a little bit more, back to 500 basis points? Can you give us a little bit more detail there?
Yeah, there's some dormant insurance investors who are continuing to see inflows, particularly out of Asia, that are compelled by the ability to source duration and the ability to source yield in the dollar IG market. I will say the caveat there is it's an up in quality move. So the lion's share of issuers that are benefiting from that international bid tend to be single A and higher. So it speaks to the previous comments towards moving up to the upper echelon of the credit markets. But I do think it's block size appetite. It's some investors who've been absent for the market during much of the bull moves we've seen over the past decade, and they're re-engaged. They're flush with liquidity. They were well positioned heading into this week's volatility, and I think spread backups and a view that might be contained in IG will continue to fuel a bid from that subset of yield-centric players.
Hey, Colin, I hear this a lot, that on the supply side, and to Megan's point, she went through a ton of stats there for us. They have a favourable maturity profile that allows them to sit out the volatility. That's the supply story. The demand story, there's a lot of cash sitting there waiting to suck up some of that yield too. You're a little bit more cautious, Colin. Why?
Yeah, we're a lot more cautious, but I will highlight that it's more on the junky part of the equation and not so much IG. Our guidance to our clients is to move up in quality, and we are very comfortable with investment-grade credit risk. We have seen a lot of outflows there for not just our clients, but across the spectrum with IG funds. That's likely more due to duration risk rather than credit risk, given the move higher in Treasury yields. What concerns us the most in high yield, well, there's no shortage of reasons. Corporate profits are disappointing, and based on BEA data are already turning negative, growth that is. A flattening or inverted yield curve usually spells trouble for high yield, but most specifically is this increase in short-term rates that will likely affect bank loans a lot quicker. If you're a bank loan issuer who issued a loan over the past year and a half, 2 years, you're looking at an annual interest expense of probably only 3.5%, given where short-term rates were plus a modest spread. If the Fed gets to 3.5% or 4%, a lot of these issuers are going to see their interest expenses double in just a handful of months. We see that's a key risk. That might not matter as much for high-yield bond issuers, but all risk assets could suffer in that situation where there'd be spillover effect. So we are a lot more cautious on high yield right now. While an 8.5% yield that Megan just alluded to, it's attractive in an absolute sense. I mean, we haven't seen yields that high over the last decade for a sustained period of time, but we think spreads are likely to move higher, and there's likely to be better opportunities down the road.
Jim, as you look cross-asset right now at equities too, what's leading what? Traditionally, I think we were all told that credit leads equity. Do you experience that? Is that your experience of things, the way things are materializing so far this year?
No, it seems like it is the other way around. The equity market on a relative basis to the credit markets is acting much worse. And as a matter of fact, if you were to strip out the interest rate component out of the credit markets, what you're finding is actually that the high yield market has done better than the IG market, the investment grade market, largely because of the rise in rates. The total return on investment grade is among the worst year-to-date numbers we've ever seen, largely because of the rise in rates. So credit has been performing a lot better, and that has been a subject of a lot of discussion around here. And I think part of it is that we still have a moral hazard that's been hanging over us since 2020. Remember, when markets went bad in 2020, the Fed stepped in and they started buying investment grade. They started buying ETFs. And there's a belief that if I buy credit, the company's going to pay me or the Fed is going to make me whole. And that's why I think that in general, over the last 15 months or so, it's done much better than the equity market has.
This is something Mohammed's been talking about. He joined us a little bit earlier this morning, Mohammed Al-Erin. He talked about the fact that perhaps we haven't fully realised what's happening here. This move away from the dominant policy regime in the last 15 years to something new. And to your point, Jim, we've seen the rate move. We've seen the adjustment there in equities, in credit. Only recently in credit have we started to see the credit risk story. And there's many people in the equity market who are still waiting for the earnings downgrade that still haven't materialised in a big way on the street. Colin Martin, Jim Bianco, Megan Graper will be sticking with us. Coming up on the programme, still ahead, the final spread, the week ahead, featuring a host of Fed speak, including Chair Powell on Capitol Hill. That conversation up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, US markets will be closed on Monday, long weekend stateside, in observance of Juneteenth, plus a host of Fed speak with Bullard on Monday, Mester, Barkin, Evans, Daly, also on the docket, and you get Chair Powell twice, heading to Capitol Hill Wednesday for 2 days of testimony. And finally, initial jobless claims on Thursday, followed by this. This wouldn't even get a mention, but now it does all the time. Every 2 weeks, you get the University of Michigan's Consumer Sentiment Survey. And this is something that Chairman Powell himself referenced this week in the news conference. And no doubt for this market, I imagine for a lot of people, this is going to become a market-moving event. With us for some final thoughts, Megan Graper, Colin Martin, Jim Bianco for the rapid-fire round. 3 quick questions, 3 quick answers. Let's get to this one first. The high on the US 10-year. Have we seen the high on the US 10-year? Yes or no? Colin?
Yes.
Jim?
That would have been yesterday, so I'll go with no.
Megan?
No.
On high yield, spreads, about 500 basis points at a close yesterday. What comes first? 600 or 400? 600 or 400? Jim?
600.
Colin?
600.
Megan?
600.
Final question. Fed funds by year end. Does it have a 1 handle, a 2 handle, a 3 or a 4? Megan?
3.
Colin?
3.
Jim?
3.
To the 3 of you, thank you. Megan Graper, Colin Martin, Jim Bianco, thank you very much. From New York, that is it for us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.